For quite a long time, local manufacturers and investors have complained bitterly about the cost of borrowing in Nigeria, with interest rates as high as 30% in some cases. The central bank policy of liquidity squeeze to shore up the value of the naira even compounded the situation. But after keeping lending rates at 13% for over 3 years, the Apex Bank's Monetary Policy Committee has decided to listen up and cut down.
The MPC voted to 1. Reduce the CRR from 25% to 20%. 2. Reduce the NPR from 13% to 11%. 3. Change the symmetric corridor of 200 basis points around the NPR to an asymmetric corridor of plus 200 basis points and minus 700 basis points around the monetary policy rate.
It's the second time in about 2 months that the CBN would be cutting the cash reserve ratio. In September, it reduced CRR to 25%, hoping that with more liquidity at their disposal, banks would lend more to the real sector. But that did not happen. This time, the CBN is attaching a caveat to the reduction in CRR.
The liquidity arising from the reduction in the CRR to 20% will only be released to the banks that are willing to channel it to employment-generating activities in the economy, such as the real sector, the infrastructure sector, the agricultural sector, as well as the solid minerals sector of the economy.
It remains to be seen how far these new measures would go in addressing the funding challenge confronting local businesses. This analyst says while the measures are the right one, more still needs to be done to make them work.
I do believe that if other measures are taken to reflate the economy, perhaps, for example, reduce domestic debts, pay contractors. The domestic debt is almost 2 trillion naira. Pay contractors. That will cost money inflow, and then the money that have been sterilized in TSA will be disbursed to fund government projects. All that will create availability of funds in the market, and then there's money in the market that will flow into the banks, and the banks can lend. If that does not happen, it will be a theoretical concept. Thank God the policy has taken, but there must be other supportive measures and policies to ensure that the expected outcomes happen.
The latest reduction in CRR is expected to inject about $1.7 billion into the country's banking sector. Now, some analysts have argued that could do more harm to the value of the fragile naira, saying it could lead to naira supply glut. But the CBN's decision to target the money supply to only banks that would lend to the real sector could put a damper to that argument. However, one huge concern will be how to motivate a banking industry already reeling under the yoke of huge bad loans to start lending again. Deji Badmo, CCTV, Lagos, Nigeria.